Hi, I'm Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. It is Thursday, August 21st. I'm still in Sao Paulo in Brazil, just coming to the end of a 3 week trip. So, this will be a slightly abbreviated podcast this week, so there's a lot to get through, and I will, as usual, share the slides. So I've called this week's podcast a hole in one, as all eyes are focused on the Jackson Hole Convention and what's likely to stem from that when it comes to the Fed. Are they likely to give any indication as to when and by how much they're going to cut rates? And equally, we've heard some chatter as to whether this will herald the end of a flexible approach that the Fed had been taking up to now, flexible in terms of how it thinks about its inflation target. There has been some chatter that the Fed may revert again to a more of a fixed inflation target, taking away some of their discretion when it comes to thinking about their policy. And that would be quite a seismic change after 5 years or so of a more of a flexible policy. So we will see what Jackson Hole holds, but certainly that's been something that has been very much on the mind of commentators in the lead up to now. As usual, we will discuss inflation, interest rates, equity market conditions, geopolitics, and other factors such as the US dollar. And what we're seeing is that tech stocks very much have been blinking this week. There has been a suggestion that perhaps AI and its impact on productivity has not been as heralded, that perhaps it has been oversold. And that has given investors some cause for concern when it comes to the large tech stocks whose fortunes have very much been tied to a perception of a hockey stick like trajectory for AI adoption. We're also, as we mentioned, discussing a complicated menu at Jackson Hole. We're going to be asking about the political side of geopolitics, whether when we sever the geo side of it and speak just about domestic politics, whether domestic politics and its impact on policy is going to have more of an effect on markets than we think geopolitics typically has. And then finally, we're going to look at the bond markets and ask whether we should listen carefully to what they're telling us about their outlook for the US economy, their belief in the creditworthiness of issuers, and whether we should listen to the bond market that is often very much the more negatively skewed view of creditworthiness and the ability of investors to repay. And let's see whether they're telling us something surprising at this juncture. We will have a guest quote appended to the end of this podcast in later editions, and that's going to be a quote from my interview that I conducted in person with Nicolas Duchovny, who's an Argentine economist and former Ministry of the Treasury between 2017 and 2019. He had some very interesting insights around the current state of reform in Argentina and predictions around the upcoming election and what the 2027 election would mean, what that would mean for growth. And we do revert to some of his core beliefs around the importance of fiscal discipline. And even though this is specifically related to Argentina, given some of what we're discussing today and the dominance of the fiscal narrative in markets, I think it's quite instructive to take some notes from what I described last week as a laboratory in Argentina in order to see whether there's any lessons that can be learned there for developed economies such as the US and beyond. When it comes to inflation, the big inflation news of this week came not from the US, but from the UK, where inflation was seen to be quite stubborn and surprisingly high at 3.8%. There can be some seasonal reasons for that, but ultimately, that was certainly well in excess of the direction that inflation had been expected to be heading. And that has now given cause for concern around the direction of interest rates by the Bank of England. It seems very unlikely that they will cut again. This unexpected surprise when it came to inflation in the UK was coupled with the sell-off in the 30-year gilt. So clearly there has been some wariness regarding the creditworthiness of the UK and regarding the fiscal situation there, as well as the fact that inflation is starting to take its toll on consumers, as well as potentially higher rates for longer. They could also take a toll on consumers and corporates there. So a bit of bad news from the UK, but a reminder for all global watchers that inflation is certainly not to be taken for granted. And as we discussed last week, even though it was falling or at least low in the US, that there were some very specific reasons for that, and that some of the stubborn service inflation had not, in fact, been in abeyance. As we can see in recent headlines, Federal Reserve minutes highlighted the split over the effects of Trump's tariffs on inflation. We've spoken before as to whether Trump's tariffs would have an inflationary effect, and if so, whether they would be transitory in nature and one-off in nature. That seems to be one consensus and point of view. But as we can see, this is by no means a done deal. It is by no means certain what the effect of the tariffs will be on inflation. So even if Federal Reserve officials are debating this, we can see how very much uncertain this is for markets. When it comes to expectations for the Fed, even though we've had some variation in terms of the expectations of 1 or 2 25 basis point rate cuts at the upcoming meeting, we can see from the chart below on the far right that there is now an emphatic bet on sustained easing, a dramatic change when it comes to the expectation around easing back in February and now the expectation of easing. So markets seem to have really lined up behind the expectation that easing is the way to go. I would suggest that some of the debate that's clearly still evident within the Fed board that that is perhaps not a done deal, but clearly investors are pointing in one direction, which suggests that if that cut is not a jumbo cut, or if there's no cut at all, that would probably count as a negative surprise for markets come September. So quite a lot to watch for when it comes to the next Fed meeting. This is also an interesting point around the long rates. I mentioned that already with respect to the UK, that long rates necessarily are not heading in the same direction as short rates. And we can see that investors have been pushing long rates higher as the dollar has weakened. So clearly there is an expectation that rates will be higher. There's the dollar weakening perhaps is a suggestion of just a weakening outlook, a lowering of confidence around the US and its fiscal state. So that could be a reason for long rates being pushed higher as the dollar weakens. But it also sits at odds with the short rates being lower, reflecting just where we are today in terms of the current set of interest rates, the belief of their direction, as I mentioned, 1 or 2 cuts in the future, and the fact that these short rates may well be seen as a safety asset and used in the case of a flight to safety. So an interesting anomaly, I would say, developing between long rates and short rates at this juncture. We've spoken before in terms of the vibe check around the economy and this concept of a K-shaped recovery. This was discussed in the aftermath of COVID, how certain segments of the economy were doing very well and continue to do well, whereas other sections of the economy, primarily blue collar workers, low wage earners, were not doing well. And it was in fact inflation on critical goods in their goods basket would take a much heavier toll on these earners than it would necessarily on the higher rate taxpayer and the higher rate earner. We can see that wage growth for the low skilled is descending towards Obama era levels. And that is shown in this chart here, that whereas wage rises for the low skills did increase, it has now been tapering off quite notably. Whereas for the higher skilled workers, we can see that that has tapered off by not to the same degree. So we are still discussing wage rises in this instance. So it's not that we're losing spending power. But when we couple these wage rises and the fact that they are now rising by less with higher inflation, we can see that the lower end consumer is definitely starting to feel the pinch of inflation and perhaps a less buoyant jobs market, as we've discussed before. So I would say this growing inequality is definitely something that we want to continue to watch as it is becoming more stark. We're seeing this not just in the consumers, but also in the stock market, this inequality around concentration. So I think this is something to note because a headline may apply to one segment, but not to others. So we have to be very mindful of the nuances and the divergence in the different sectors of the consumer segment. Again, back to this idea of the vibe check. When we look at some of the tech wobbles, what has been stemming that, what has been the source of that? I mentioned the MIT study around the expected productivity gains to be had from AI. We're also hearing that Meta, after stepping up for a bumper payday for their AI new hires, they now are freezing AI hiring after their blockbuster spending spree. So this kind of on again, off again approach to AI spending only, I think, underscores just the relative novelty of this AI spending, the fact that we were really in outlandish territory when it came to some of the pay packages that were disclosed, that this just came out of nowhere. I think it also made it seem even more unreal. And now that we see there is a little bit of perhaps prevarication by some of the tech stocks regarding the spending, this is sure to add more concern to the already existing wobbly mood when it comes to tech stocks. And again, that we're seeing in this chart here that from July 9th, quite a volatile ride when it comes to US tech stocks, We know that they took a dip around the beginning of August when the expiration of the tariff deadline occurred. They've been rising fairly steadily since then until this week when we had this wobble. So this kind of a volatility in tech stocks is something that we're going to expect to see more and more of as we see these stocks trade at lofty valuations, supported by earnings growth. These are not illusory sources of earnings. So I would add that as a caveat. But when we have this kind of volatility within a stock, it should not be then a surprise to see that volatility on the upside can be matched by volatility on the downside. So a difficult time for investors very focused on the US tech stocks just this week. I think to add to that, we're getting a little bit of geopolitical spice added to the mix. We can see that China is now turned against NVIDIA's AI chip after so-called insulting remarks from Howard Lutnick, the Commerce Secretary. There has been a bit of a war of words at work between China and the US, which I say has been more around rhetoric than actual practical implications so far. We also saw the president suggesting that the CEO of Intel should step down because of his perceived conflicts of interest. So I'd say more of a war of words than actual trade war or trade sanctions at this point. But it doesn't help when something is perhaps priced for perfection for something like this to take quite a bit of steam out of a rise like we're seeing for Nvidia. So again, just to watch how political policy, geopolitics can affect some of the tech sentiment. We're going to see more of that. Switching narratives then to another drumbeat that we've been hearing this week. It has been around a new era of fiscal dominance, suggesting that the focus on the fiscal side of the equation is going to only continue to grow. We're seeing that already in the UK. I mentioned the sell-off in 30-year gilts. Clearly, the investors in the UK are not liking what they're seeing. They haven't liked what they've seen for some time. They particularly didn't like what they saw during the short-lived Liz Truss prime ministership, but they're not liking what they're seeing at the moment either around the fiscal state in the UK. So that can definitely drive markets. And I would suggest that some concern around the fiscal side of things has started to drive some of the weakness in the US dollar. So this record government debt, rising borrowing costs, putting the central banks under pressure in the sense that will they be forced to use their monetary lever against the backdrop of this fiscal situation, or will they continue to be firmly independent in that respect? So again, more of an interesting thing to add to the mix, which will no doubt be discussed at Jackson Hole. Again, digging into some of the numbers, when I look at what some of the big tech stocks have been displaying in terms of their capex, their commitment to capex and the fact that they were very much deep pocketed and cash rich, that was adding to the narrative that tech stocks could only go in one direction, that was going up. What we can see is that actually the capex of the big seven tech companies has been rising quite considerably. It used to be that these were capital light companies. The tech, part of the reason it could attract such lofty valuations was the fact that it was not generally seen as a capital intensive sector. Now we can see that this capex spending being so significant because they essentially do have the cash has transformed tech companies so that now the capex to operating cash flow is almost equal across the board when it comes to big tech and the rest. So everything else except financials. I think this is an interesting thing to watch because if this capex tap were to be turned off and some of the tech companies were to start behaving like tech stocks again, what would that do to the valuations and what would that do to the narrative? This is again why when it comes to AI, we do like capex expenditure when it comes to the picks and shovels, the companies that are traditionally the sources of capex, because we believe that this will be enduring, whereas some of the tech spend may actually be damaging in terms of the tech companies themselves, as so much of their valuations are riding on that capex spend. Returning to a topic we started to raise last week around concentration. I think what it is notable is that we've been speaking about concentration in the stock market for some time, but I don't think we've actually fully looked back at the last, say, 25 years to see, is this concentration different this time? And this chart from Bloomberg does look back every 5 years at the share of the top 10 companies in the S&P 500. And we can see that the last time they were we were even close to the concentration level we're seeing today was into 2020 We had the top 10 representing 29% of the stock market. In 2000, the top 10 represented 25.8. Today, the top 10 stocks of the S&P represent 39.8, so almost 40%, which has more than doubled in 10 years. So that is quite a staggering concentration that we're seeing. And we will continue to discuss this theme throughout this podcast over the weeks ahead, because this is really starting to change the shape, the rhythm, the complexion of how equity markets behave when we have this level of concentration. It also significantly affects the ability of active managers to add value against this kind of beta driven market, which is ultimately rising and falling based on a few small constituents. So I'd say definitely watch this space, but it is somewhat notable to see that the concentration we're seeing today is very unusual, and in fact double what it was 10 years ago. When it comes to the politics and geopolitics, what have we been talking about this week? Well, clearly the Alaska summit and the state of the Russia-Ukraine war and any peace negotiations have been considerably in the news, and we're not at a point of resolution yet. Given it's summer, we haven't seen European stocks move as much as they might if it were, say, winter, and we were looking at the concern around supplies in that region. But what we can see, though, is that the demand for defense stocks has been fairly consistent. And we've seen that this discussion around the increase of spending around defense in Europe has been a real boon for stocks such as Rheinmetall. We can see that this has continued to outperform. And basically, if we look back, according again to Bloomberg, this outperformance has lasted 25 years, essentially. So a very good place to have invested certainly was in defense stocks. And when it comes to what the markets and the betting markets are saying around the prediction for a ceasefire, we can see that we've pretty much lost hope in terms of the poly markets, in terms of there being a ceasefire this year or Ukraine ceding territory this year. We did enter the year with quite high hopes. The idea of a ceasefire was up around 60 or 70%, perhaps based on a promise made by President Trump in the early months of his administration. We can see as the months have rolled on just how delicate and difficult the situation is proving to be. And now essentially the betting market has given up on that idea. So clearly not resolved yet, a lot to watch there. Last point is around the bond market. And I thought this has been interesting. We've heard from some time from fixed income managers that they have not seen much to do. They have been a bit disillusioned by the tightness of spreads and the lack of buying opportunity in the across the board in investment grade fixed income. And also now we're seeing that high yield has been extremely resilient with tight spreads across the board there, with the exception of the very riskiest of high yield bonds, the triple Cs, that ultimately the spread relative to the risk-free rate has been at historic tights. And what is this telling us? This is telling us that the bond market is exuberantly confident and has no fear of any incoming default cycle or even kind of cracks appearing in the creditworthiness of many of these borrowers. I have heard a suggestion that if the private credit market had not been as well developed as it had previously been, and now we can see that it is quite well developed, probably close to 3 trillion and above, that if the private credit market was not at that stage, that there would be far more hair or general just weakness within the mainstream fixed income market. The suggestion there being is that the riskiest borrowers are now not issuing bonds in the traditional way, but are instead accessing the private credit market. And the private credit market is therefore mopping up the lower credit worthiness, those with the lower credit standing, and that the traditional fixed income market is only for the very most reliable of issuers. That's one theory. We could also suggest that maybe the bond market is too confident, and or that some of the default circumstances just are not occurring today because we are essentially kicking that can down the road and extending. It could also be that the interest rate environment has been so well telegraphed that many of these companies have locked in favorable terms at an early stage and are not therefore facing default. But it is interesting to see just how resilient the fixed income market has been, which also suggests that there's not much upside in the fixed income market today, given that upside generally is capped within fixed income. So again, something to watch as we see fixed income as a natural alternative to equities, but not looking very interesting from a return standpoint today. And finally, on the dollar, we've spoken before about the dollar, the weakness that we're seeing, but with a brief respite that was seen in the last few weeks. The suggestions now that the next move of the Fed will be down, that should generally be negative for the dollar, as it would be a lower yielding currency. What we can see is that the demise of the dollar has represented a strong opportunity for emerging markets currency, and that the emerging markets carry trade has been performing very well as the dollar has continued to weaken. So that is it, a slightly abbreviated podcast for this week. Next week, we will be joined by Torsten Slok of Apollo, a fantastic and very popular market commentator. We'll be cycling through all of the usual topics with him. Look forward to seeing you then. Thank you.